All right, let's dive into this explainer and completely upgrade your financial valuation toolkit by moving beyond those rigid old models to something truly dynamic. Welcome. Today, we are tearing down some of the most deeply ingrained assumptions in traditional finance. If you've ever felt like your standard spreadsheets are somehow missing that real-world magic of human adaptability, well, you're in the exact right place. We're going to explore a concept that fundamentally changes how we look at risk, uncertainty, and strategic decision-making. So, here's how we're going to break this down today. First, we'll look at the massive flaw in the traditional DCF model. Then, we'll define what real options actually are, how calls and puts factor into flexibility, and apply all this to a high-stakes case study with Bharat Pharma. We'll wrap up by looking at the phase gate model and ultimately the hidden value of uncertainty. Okay, starting right off with part one, the inherent flaw in the traditional discounted cash flow model and this battle between passive assumptions and active management. To really appreciate the solution here, we have to confront a pretty massive flaw in a sacred cow of finance, the good old DCF model. Think about how a discounted cash flow model actually works. You plot out your cash flows for the next 5 or 10 years, you discount them back, and boom, you get a single number. But there is a huge, rigid assumption baked in there. It assumes management is completely passive. It's like pressing go on day one and just blindly following that exact same path for a decade, totally ignoring what the market does. But come on, that is not what good managers do, right? If a project is crushing its targets, management expands it. If a project is failing miserably, they pull the plug. DCF completely ignores this adaptability. Real options, on the other hand, actively value a management team's ability to pivot. Which brings us perfectly to our second section. What exactly are real options? Let's lay down a conceptual foundation. So let's formally introduce the hero of our story. If we know the traditional DCF falls short, what exactly is the mechanism we use to fix it? Well, it's the real option. And what I really want you to notice here is the emphasis on the right, not the obligation. This is absolutely crucial. It means you have a choice, which is fundamentally different from a binding commitment. Basically, a real option takes the famous Black-Scholes financial option theory, the complex math used to price stock market derivatives, and it applies it directly to physical, real-world business investments. When you have a real option, you hold the power to take action later. You aren't forced to do anything. You just have the privilege to act if and only if the conditions are favorable. And mathematically, this proves something amazing. Flexibility always adds value on top of your baseline passive projection. Your adjusted present value using a real option is basically just your standard net present value from your DCF plus an option premium. And here's the golden rule you need to remember. That option premium is always positive. Seriously, having choices never hurts you. The ability to wait, gather information, and then decide, that is inherently valuable. And this framework finally puts a precise dollar amount on that strategic flexibility. All right, let's move into part 3 and talk about calls, puts, and how they translate directly to strategic flexibility. Now, you might already know terms like calls and puts from stock trading, but we need to map those financial concepts onto real-world business actions. It's actually a brilliant dynamic. Think about investing in a small pilot program. That is basically buying a call option. You're paying a premium upfront for the right to expand later. If that first phase is a massive hit, you exercise your call option and capture all that upside. But, well, what if things go south? That's where the put option comes in. Management has the right to abandon. You can stop the bleeding, halt the project, and maybe recover some salvage value. It creates a strictly bounded downside. You literally only lose what you've put in so far. But your upside, that remains totally open. So, let's see this in action. Section 4, our case study on Bharat Pharma and their oncology drug R&D. Let's take all this pure theory and drop it into a multi-million rupee reality. Honestly, there is no better industry to demonstrate the power of real options than pharmaceuticals. We're looking at an oncology drug pipeline, a sector that is absolutely notorious for sky-high upfront costs and massive, massive uncertainty. This is exactly where standard models completely fall apart. Imagine Bharat Pharma is developing a new cancer drug. If you try to run a standard DCF on an early-stage drug, the sheer probability of failure in those early trials will drag your expected cash flows so far down that the net present value will almost certainly be negative. A DCF would literally scream, never invest in R&D. Yet, pharma companies invest billions every single year. Why? Because they aren't treating these drugs as fixed, unbreakable commitments. They're valuing them as a series of sequential options. And that perfectly tees up Section 5, the phase gate model of sequential investments. Notice how at every single gate in this process, from initial safety testing all the way to launch, the costs climb while the success rates fluctuate wildly. This means management is constantly exercising either their right to abandon or their right to expand. Take phase 1, the safety phase. Bharat Pharma is only risking 25 crore rupees. They've got a 70% chance of success over a year. If it passes, they unlock the option, again, not the obligation, just the option, to spend 80 crore rupees in phase 2 for efficacy. Now, phase 2 is the riskiest hurdle, with only a 45% success rate. But if it fails there, they just abandon it. They don't have to throw away the massive 220 crore rupees required for phase 3. This whole phase gate process, it's just a natural sequential call option. They pay small premiums early on to buy the right to invest the big money only when the odds of success have actually shifted in their favor. Which brings us to our final section, Part 6, the true value of uncertainty, and looking at the Black-Scholes output. So, finally, we take these daunting phase gate numbers and run them through the Black-Scholes real option model to find the actual, tangible value. We plug in the costs, the timelines, the success rates, and look at this. We have a massive asset value, the S variable here of 1,008 crore rupees. That is the present value of the cash flows if the drug makes it all the way to market. Against that, the K variable, our total potential investment across all those phases, is 385 crore rupees. But to calculate the actual option premium, to really quantify the value of management's flexibility to hit the brakes or hit the gas at every single gate, we need one final critical input, a metric that captures the sheer unpredictability of this entire journey. And that number is 55%. This represents the volatility, or the sigma, of the project. In the Black-Scholes formula, volatility is basically just a measure of how wildly the outcomes can swing. And as you can imagine, in a complex oncology trial, the volatility is off the charts. You could have a blockbuster drug that changes the world, or you can have an absolute zero if regulators reject it. Now, here is the ultimate counterintuition. Unlike traditional finance, where risk is seen as entirely bad, in real options, higher volatility actually drives the option value up. I know, let that sink in for a second, because it completely shatters conventional wisdom. Usually, when volatility goes up, your valuation drops because you're heavily discounting those risky cash flows. But with real options, high volatility is actually your friend. Why? Because your downside is strictly capped. If the drug fails in phase 2, you just stop. You don't lose that phase 3 money. You've bounded your downside. But if the drug succeeds, the extreme volatility means the ceiling for profits could be astronomically high, and you get to keep all of that upside. So the more uncertain and volatile a project is, the more valuable your flexibility to abandon or expand becomes. So what does this all mean for you? Well, as you build your next projection, ask yourself, is relying on a rigid, passive framework causing you to systematically undervalue the most important asset your business has, human adaptability? A static DCF model basically assumes you're trapped on a moving train with absolutely no brakes. But real business isn't like that. It's about steering. It's about hitting the brakes when you need to and slamming the accelerator when the road opens up. That flexibility to make choices has immense mathematical value. If your model isn't capturing the option premium, what other massive game-changing opportunities is your business leaving completely on the table?